Welcome back. So in this video, we're going to talk a little bit about the venture capital cycle. Now, I'm going to oversimplify it here, and then we'll get to some more of the finer points in just a second. So if you look at it, very holistically, the first thing that happens is the fundraising. Okay, and this is not, something that has an exact timetable, and let me explain why. There's two reasons. One, you have to wait till however long it takes you to raise. Let's say, your venture capital fund is going to have $10 million to invest, right? Okay. Who knows how long it'll actually take to raise that $10 million. Additionally, when the investors in the venture capital fund commit to investing in it, they don't have to provide all that money on the spot. Okay. So these venture capital funds normally have like a life of maybe around 10 years. And so it might be that you commit to investing, maybe your individual investment as an investor is $1 million, okay? So maybe you secure that commitment with $100,000 just to hold that spot, and then maybe once the investing actually starts, then you give another $400,000, and then maybe year two you give another $400,000, and then you give the last $100,000 in year three or something like that. So the fundraising is has a really nebulous timeline. And you're probably thinking, okay, did I just hear you correctly? When you fundraise, or when you as an investor participate in this fundraising process, your money is locked away for 10 years. Yes, you heard that right. And so what you're probably thinking is, okay, why would anybody lock their money away for 10 years like that? Okay? The reason is venture capital funds tend to have returns that outpace the stock market. Okay. At least once you get past like the 3 to 5 year mark, once a divestment occurs, they tend to outpace the stock market. That's why you do it. Okay. Now, another reason is, you're looking at diversity of your investments. If you're a really rich person, you'll have some money in stocks, some money in bonds, some money in real estate, some money in commodities. And this is yet another asset class that you can invest in. And, there's not exactly the strongest correlation between the performance of a venture capital fund and that of the overall stock market. It's just kind of its own little separate category. So it gives you just that little extra amount of diversity. Okay. Now, here's some other things that you want to think about. When you as an investor are participating in that initial amount of money that you're giving in, at least at the beginning, the identities of the firms in which you are investing will be unknown. You won't actually know. So you've got to have a degree of trust in the fund managers. We'll talk about that in another video in this playlist. So you've got to have some degree of trust in the fund managers. Okay? So that's part of it. The second thing you've got to look at is the fact that the returns vary by asset class and by vintage year. So the returns within the portfolio itself are going to vary wildly. And we'll talk about this a little bit later in this playlist, but a lot of the companies that you invest in are going to be a loss. Some of them are going to be at cost, but then there's just a few that will generate small returns, or they're going to generate returns of up to five times or more of what you've actually invested. So, there's a huge diversity in the actual returns. The other thing you've got to remember, I talked about how there's the fundraising and then the investment and then the divestment. So for each round of the venture capital fund that goes through, that's what we can refer to as vintage year or vintage cycle. And the returns will also vary wildly according to this vintage year or vintage cycle. So if you're in the first group, you may have one set of returns. Ideally, it's like a pretty good return. And then you normally think maybe the second or third rounds might have less return. Okay? But there's some exceptions to that. So it varies wildly by asset class and vintage year or vintage cycle. Okay. The first thing that you want to think about, let's say that you want to be an investor in a venture capital fund. What do you actually look for? Right? So in the fund itself, you're going to look for a track record. Does this venture capital fund and the people managing it, do they have a good track record? Do they continuously make very, very good returns for the people that invest in them? Okay, you want to know that. You want to look at the team. Okay, what kinds of people are on these teams? Are you just looking at kind of your Wall Street type investors, or do they also have like a great support network that goes along with the fund, like good lawyers, good accountants, people that can actually do more than just the numbers, but help these actual entrepreneurships that the fund is investing in grow. You want to look at that structure of the team. You also want to look at the fund strategy. Does the fund have a strategy that matches your particular interests? Maybe the strategy for the fund is looking at like tech and telecom and biotech and maybe some really high risky things. And if you're a high risk investor, maybe that's okay for you. Or does it invest in some maybe lower risk things, almost looking more like private equity? Maybe that's a better fit for you, right? So you want to make sure that their strategy for investing and then your own personal risk strategy are in alignment. You also want to look, are they investing in something that is a viable market opportunity or a series of viable market opportunities? Now granted, you won't know the identities of the individual firms, but let's say like biotech is really hot right now and they are specialized in investing in biotech, that might be a time to invest it. Maybe they're investing in something else that is less attractive as a market opportunity and you might want to stay away from that. So that's something to consider too. And then you also want to look at what we call the general partner / limited partner alignment. This is basically agency theory in a nutshell. Are the people actually managing your money operating in such a way that maximizes your interest as the investor, or are they maximizing their interests as the trustees of the manager? So those are some things that you need to look at. Now, what is the team managing the fund actually looking at when they're investing? Okay? They need to be looking at firms that have a clear value proposition. Okay? Is the company solving a real problem or not? Or is it just a straw man? So they need to actually show that there is a problem in the market and they have a very clear way to solve that problem. Okay? Is it a scalable business model? Some things are just not scalable. Is it something that can start off as like a one-man shop and then grow with the same rate of success when it becomes a 1,000-man or woman shop? Okay? Is it scalable? And there are a lot of businesses that are not scalable that are not really appropriate for this. Again, think of some people just don't want to grow past a certain point. I'll use this example again. My grandmother has an acupuncturist. She is totally booked up with clients. She has no more time to do anything else. She's not going to do anymore. So that would be something that is not scalable. Okay? Versus something like tech, like selling an app. Well, you can make a certain number of apps, by yourself, but then you can make dozens and dozens of apps and you can really create a new market and then penetrate that market on a very large scale. So that's what they're talking about by a scalable business model. Then they're going to look at the team of the entrepreneurs. We had a speaker who came to McMurray and he made an interesting point. He said, I do not invest in businesses, I invest in entrepreneurs. The synergy between the different entrepreneurs within that team is going to be huge. They don't look at like really, really smart people per se, but they look at people who are going to be able to improvise, adapt, and overcome. Okay? Because again, when you're looking at things that venture capitalists, those particular markets where venture capital is a big deal, there's all sorts of uncertainty as opposed to risk, and so you need people that are comfortable in swimming in ambiguity. Okay? So you need a good team of entrepreneurs. And a good example of this that I think of, I remember watching the Olympics with my dad a few years ago, and it seemed like we were watching the basketball thing. And it was like Team USA versus I think it was Team Serbia. Well, Serbia is a really small country, right? And not exactly a wealthy country, so you don't think of it as having great athletes. And in the US we had Allen Iverson, like a bunch of guys from the Lakers and all this kind of stuff. And the Team USA got beaten by this team from Serbia. Why? Yes, the U.S. and we had more individual talent, but they didn't really work together and they didn't play as a team. Whereas the Serbian team practiced and trained together all the time, so they kind of had that synergy. By the same token, it's not enough to say I've got people from Harvard, Stanford, Yale, whatever. That's not as convincing as this is my buddy. He and I have known each other since we're 6. We've been through it thick and thin. He knows what I'm thinking. I know what he's thinking. We're on the same page, and together we can conquer anything. Okay, so that's something that they're going to be looking for too. And then the other thing that you want to look at, or that the investors themselves will be looking at, is they want to have diversity in the portfolio, right? So we're going to look at market risk and product risk, and possibly both, but at least you want to have some balance. So market risk means that you take a product that is proven, but you test it in a brand new market. So it could be something like, Uber is a good example, right? I believe it started in Silicon Valley. It was kind of working in the Bay Area. And then it expanded to the US, but then they said, you know what? I wonder if Uber and these kinds of services will work in Europe. That's a brand new market, so that's a market risk. Product risk, though, is when you are testing a brand new product in possibly an established market. And you may take product risk and market risk, right? What's an example of product risk? Well, think about if you had... So we want to think of an established market, but something that's really cool and growing really, really fast. Okay, how about virtual reality? Okay, that is becoming more and more of an established market, just for the sake of argument. And then you've got a brand new virtual reality, I don't know, like a boxing machine. Like you can box with your favorite boxer in some sort of a virtual reality kind of a gaming type, right? That would be a brand new product that's being tested, therefore it's a risk, into what is becoming a more and more established market. Okay. Now, if you had the other assumption that virtual reality is not an established market and you introduce this game, then you're taking a product risk and a market risk. Okay. But you want to have some diversity there. Okay, so great. The venture capitalists have made their investment. Then what are they supposed to be doing, right? Well, it's more than just actually throwing the money in. They should be providing some support. And again, this goes back to you as the investor in this fund to do your due diligence on the team that's actually making the investments. So the actual venture capital management team, they're going to be monitoring, they're going to be adding value, and they should be doing something to grow the portfolio. And with the individual companies, they should be helping with sales. They should be helping with operations. They should have a team that can help with product development. They should be able to help their entrepreneurs get additional financing if needed. They should be able to introduce their entrepreneurs to people within brand new networks that it can help them get their products to market. They can help give them new ideas. They provide consulting and sounding board advice. They also help with corporate governance, and they may provide a variety of other services like free legal services, free accounting services, these other kinds of things. Because remember, the venture capital fund wants the companies in their portfolio to actually grow and do better, because when the entrepreneurs grow and do better, then the fund has a greater chance of being successful. It has a greater chance of making profits. So that's what they should be doing. Then, after around this 5-year mark, then we start looking at divestments, aka the exit. Now, some of these forms of exiting I've already talked about on my YouTube channel. The one that we always think of is the IPO. That's when the company has done so well that you're going to start trading it on a public stock exchange. That's really cool. And again, that's probably the best way from a profitability standpoint for the investors to recoup their money, because then they're talking about having shares that can be traded on a public stock market. It gives the investors a little more control. Okay? You can also do a trade sale. Again, when you're thinking of really small companies that are growing, maybe a rival will come and just buy the thing wholesale. That's another way to cash out. Okay? There can also be a secondary sale where the venture capital fund may be one of several funds investing in a particular venture, and venture capital fund A will have the opportunity to sell out its portion to either another partner of that particular entrepreneurship or new venture, or they'll have the opportunity to sell it to a firm that has a very different risk profile. So let me give an example. Some venture capital companies, as I mentioned, only invest in seed companies. Okay, that's really, really high risk, but also very high returns. But as they start moving into the startup phase, the risk goes down, but then so does the rate of return. But that's okay for a different venture capital group, right? They may wind up coming in and they may really like buying things that that have transitioned from seed to startup, because they like those other venture capital funds. Venture capital fund B will like the lower risk, even though they're going to have to sacrifice return. And then again, as I mentioned, there's some that focus on growth and expansion, who may specialize in buying through a secondary sale the partial ownership of a firm that has transitioned from startup to the growth phase. Okay, so it's looking at buying out for different risk profiles, risk and return profiles. There can also be a share buyback. Okay, so the actual entrepreneur, for example, may buy back some of the shares with the entrepreneur's own money from the venture capital fund, and that's a way to repay the investors. Or when it's just a total loss, you wind up just doing a write-off. You say, you know what, this one's a total loss. We're going to use this as a write-off, and we're going to focus on the firms that actually have a chance of making their money. So we've talked about a lot of moving pieces here. If you have any questions, post them in the comments down below. As always, give me a like, that's a thumbs up, and make sure you hit that subscribe button. And let me ask all my YouTube watchers this. Do any of you have any experience looking at any of these funds? Do you follow any of these publicly traded funds? Is this something that you're actually interested in? Which side of the table would you rather be on? The side of the fund managers, of the investors, or in the entrepreneurs in this particular case? Let me know in the comments below. I'd be curious to hear your feedback. I'll see you in the next video.